Good morning, everybody, and thank you, Mr. Kapoor. It is the second time I am with the OGTC, and last time also, and this time again, I have found them to be very visionary, very forward-looking. I didn't really expect that a subject of taxes and also future of the taxes more than the present taxes would win so much of interest. We are very critically poised in India now, and both direct as well as indirect taxes are at the threshold of some very major reform. DTC is more or less reached some kind of consensus and agreement, and it's at a very advanced stage of implementation. Hopefully by this winter session, the bill will be in the parliament, and from the next year, it will start getting implemented. But when it involves 28 states and very diverse states, GST today has become one of the most complex reforms that country is facing. When I joined the tax research unit, people tried to tell me that there are issues because political parties want it this way, that way, etc., etc. The more I started my own journey of discovering the complexities of this tax, the more I was convinced that there is very little problem with the political sides. It's more with the design of the whole subject. India was pushing a reform of very mammoth proportion with a speed that people were unable to match in the beginning, and as they learned with the expiry of time that is going to impact them so significantly, some amount of opposition and the desire to be clear before they go ahead was always there. So today's journey also is to expose you people to what GST is. Unlike some of the developed countries where long debates are held before major reforms are taken, somehow I found in India we decide that something is extremely good and we take it for granted that it is going to be a game changer, etc., etc., without really understanding what the details of the reform is and how is it going to impact different sectors. So today's presentation I have tried to balance, considering that some of you will be aware of what GST to some extent it is, and some of you would like to get into how it impacts apparel sector and textile in general. So please pardon me the first few slides if they sound too basic. I'm going to cover up my presentation in little more than half an hour, maybe 45 minutes, leaving enough time for you to raise questions and then any specific queries on service tax also. See, first thing is I found most well-informed bureaucrats also feel that we have implemented VAT and GST is some new animal. The first thing I want to clarify to you is that globally GST, VATs are interchangeable names. Whole of Europe calls their taxes as VAT. Some countries like Singapore call it GST. Some countries like Canada call it HST, Harmonized System of Taxation. GST there has an entirely different meaning, and so on and so forth. So first of all, don't go by the name. So GST is another form of value-added taxation, and when the titles may vary, what it basically says is that all turnover of a business entity will be liable to be taxed if it is above a certain specified minimum threshold, minusing the taxes paid on the inputs. That's the sum and substance of a GST or a VAT kind of a system. Now, why GST? A lot of people tell me government is becoming very complicated. Why don't they just put a 1% tax on every transaction or a 2% tax on a transaction and so on and so forth? Now it pains me to tell them that this is precisely the system that prevailed in the world in 40s. Now you're basically trying to suggest to go back to 30s and 40s and 50s. Because when you impose a 2% tax, now imagine a huge plant which does practically everything itself. Let's say it mines then it makes steel, then it makes forgings, then it makes component parts, then it makes a car, it does everything. It will pay 2% on a car. And somebody else who outsources everything to the maximum possible extent will pay 2 multiplied by as many stages as possible on the car. So that is not the way to collect taxes, that is not the way to go for production. We are in a stage of specialization, we have to encourage division of labor and so on and so forth. So those kind of suggestions are not vertical. It distorts production, it distorts trade. The other question people ask is, when the biggest economy in the world can live without VAT or GST, why not India? In fact, the 3 biggest countries in the world are now without a VAT kind of a system. US, China, and now India. The US has a retail sales tax. Naturally, the question arises is, why are we getting into this mess? Now, if you do not charge tax on manufacture at any stage, there is no revenue lost. If every retailer in the country is honest, then retail sales tax is the best tax, because you are collecting the tax from the consumer at the final stage without the complexities of the SANVAT credit rules and so on and so forth, and harassing manufacturers and everybody. In Singapore, for example, they do not call their manufacturers as taxpayers, because they are agents. They call them my tax facilitators or tax agents. They collect the tax from the consumer for the government. So most of the people, I presume, who would be in this hall are likely to be in that role predominantly. All of us are, of course, consumers. You are basically collecting a tax that should finally be passed on from the consumers. So any design that any government does where a part of the tax is retained as a cost for the business is an inefficient tax. All my years in tax research unit in particularly, we were trying to design policies whereby no tax is retained by the business. This is not easy because governments don't like to be transparent all the time. They want to camouflage taxes. They don't want to pass on all the credits so that the burden of taxes to the consumer appears less. Now, this is one of the oppositions to the GST also, because excise today, a central excise tax, is not visible to the consumer. It's only the state VAT taxes that are visible to the consumer. But the disadvantage of a retail tax is, if the retailer evades, the entire tax is evaded. Therefore, you want to capture tax as early as possible, because you believe that the bigger manufacturers will have less propensity and less competence to evade taxes. So you would rather tax steel or a polymer or the basic raw materials, so that even if somebody finally evades tax on something, you only lose some 10-20% of the value addition, and you don't lose that. But in US, right from the 1930s or 40s, they found that they were having some kind of organized retail. And they worked out that mostly their kind of retail, and with cash registers, I think they used to call it, which got replaced with computers, they had a fairly decent retail mechanism or organized retail. So they were quite happy. And plus so many other reasons, but US is now struggling to introduce VAT as well, as is China. In 1965, you will see there were only 2 countries which had VAT, now 155. And mostly it's all in the last 15 to 20 years. Which are the countries don't have that? Middle East, US I mentioned to you, and small islands. Is GST good? Now this is a tax which works very well when your GDP is high, and countries that are less open to trade. You will see why. And this is the kind of debate I would have liked before GST accepts or receives such wide acceptance that it seems to have already received with the industry. You got to see, it's going to really impact you positively, and how much and how and why not. And this is the market test. How many countries have ever removed a VAT GST once adopted? There are only 5, and 3 of them had to reintroduce. So there is something good about this tax. I think enough of the introduction. Now let's see. First misconception about the GST is that we got to do something entirely new. No. we are already a VAT country. We are not only a VAT country, we are an advanced VAT country. In fact, we figure in one of the 155s rather than the ones which do not have it. Only thing is we don't have a comprehensive VAT. But these are the VATs that you must have experienced. We introduced Mod VAT, modified VAT in 1986 by the central government, replaced by SAN VAT, that is allowing you credits of not only goods but also input services in 2004. In fact, to be strictly speaking, there is no duty like central excise duty anymore. That nomenclature got changed to central VAT in 2004 itself. But both sides continue to refer it to as central excise duty. Actually, it is SAN VAT duty now. And 2005, we introduced state VAT. All of you are familiar. And between 2005 and now, a lot of features of a VAT have been improved upon from time to time. So we are getting closer and closer to a GST. GST is going to be a more comprehensive kind of a VAT, as we will see in the next few slides. So what is that is lacking in the Indian VAT, and why are we shy of saying that we are a full VAT country? But what is wrong with the Indian VATs or VAT systems? We still have a tax called Central Sales Tax of 2% on origin, which is not SAN VATable or creditable and so on and so forth, which becomes a cost to the business. And therefore business have to organize their logistics in a manner that the burden of this 2% is kept minimized or sometimes completely done away by a series of logistic arrangements. Many activities are still outside the state VAT: petroleum, electricity, stamp duties, services, entire real estate sectors, taxes on vehicles, and so on and so forth. Then there are limitations with the central VAT, that we do not have the power central side to levy tax post manufacture. So SAN VAT is levied only up to manufacture. Anything beyond manufacture is not today chargeable to a tax by the center. The next problem is that you do not have the cross utilization of credits, first of all across states. If some tax is paid in Punjab, it cannot be taken credit in Delhi and vice versa, and then between the states and the center. So as a result, we operate as 28 small separate tax countries rather than one single common market. And each state has its own laws, so there is a lack of harmonized law and procedure. Now, this makes Indian tax system one of the most complex in the world. There is this Tax Administrative Reform Commission, which has given itself the vision that we are ranked 156th in the world on the complexity of our tax system. One can question that number. I would certainly like to do that, but even if one improves in that, you can imagine a country of our size and ambition, aspiration, and so on and so forth. Now, we cannot think of living with a tax system where we are ranked so poorly at all. So something needs to be done very, very urgently. Now, those who haven't still understood what GST is all about, let's have a look at how the whole system is. See, as of today, the things are green are where credits are allowed, and those in red where it becomes an embedded cost. So you have a central excise and service tax, and its credits are allowed wherever they go. But if you are paying a central excise on petroleum products, the credits are not allowed at all. So it becomes a cost. Now, can somebody guess how much money is therefore lost or is borne by the business? Petroleum tax is not being allowed. 50,000 crores is the cost of these.
So what's the meaning of tax not being allowed?
So if you pay a tax on petroleum, let's say a diesel, you pay a tax, it is not allowed as an input tax credit to a factory if it is using diesel to generate electricity. With the result, your product, you have borne that cost. So when you export, you are refunded the taxes that you are paying at the last stage. The last stage you have paid not only the tax on the product, but you have also borne the tax on diesel. So you don't get a refund. Your exports are not competitive.
So to that extent, it's double taxation.
To
It's
that
taxation
extent,
on-
yeah, the
to that
correct word
extent.
they say is cascading.
Cascading effect is
Yeah,
there.
so
Right.
cascading, basically. The idea is that if an exporter exports a product, he should get full 100% refund of the taxes. Taxes should not be exported. So to the extent they are not passed on, they are being borne by the business. You can take it otherwise. After all costs are passed on, but you don't pass them on as taxes then. You pass them as a higher price of your product. So, see, as an economist, if one gets into the discussion, you'll find a lot of things start getting distorted then. For example, you have one kind of a taxation on railways, another kind of a taxation on road transportation. By virtue of the taxation, you should not be choosing your mode of transportation. So with the result, people are choosing inefficient means of transportation and so on and so forth. And finally, the economy starts becoming more and more costly. So when you say China is more competitive than India, one of the reasons is this, that we are into a distorted economy. And to that extent, everybody in the business has to bear those costs. So petroleum to petroleum is allowed, but petroleum is not allowed when they go into all other goods and services. If you take the state VAT, this is not allowed. This is also a cross. Now you see how many crosses are there. All this red is a cost to the business. Okay? And what will GST do? You still have these boxes. Instead of all the miscellaneous taxes, there will be a central GST and a state GST. And there will be all the taxes on services, they are all getting merged into SGST. There will still be some supplies outside the GST. We are not getting a perfect GST because states are not agreeing to subsume alcohol, petroleum, for example, and some other things out of that. So you'll find the number of crosses are going to come down. CGST would be allowed against both SGST and CGST. SGST will be allowed against both. So state taxes can go into center, center can go into states. All that is fine. But things that have been kept outside the GST will remain a problem area. And plus the local body taxes, which is, I'm saying, state supplies outside the GST. Just a few quick slides on what the constitutional bill that has been introduced in the Parliament in 2011. It is going to undergo some changes in the winter session. But basically what we are talking is that there will be two GSTs, central GST and a state GST. Ideally there should be one GST collected by, or maybe two GSTs collected by one government, and then the amount could be given to the states or to the center. World over, center collects the entire two taxes for federal governments and gives its share to the states. The only exception is a province called Quebec in Canada, which is a French-speaking province. They call it a country within a country, and therefore Quebec doesn't want to submit itself to the full authority of the federal government of Canada. But there again they have agreed as a special arrangement that Quebec will collect not only their own tax, GST, but our central government also. So their center has surrendered to the state. That okay, you collect for both and pass on our share to us. But there is nobody I know in the world where two people are collecting taxes on the same base. So that way Indian GST is going to be unique. Okay, it's necessary because we are recognizing the federal nature and states want to have their own authority to not only levy and collect. So it will be levied on all goods and services except petroleum for the time being. It is in the constitutional bill, but they will not impose GST on petroleum. It will be central excise and state excise separately on petroleum products. Alcohol, states are not agreeing at all, so alcohol will remain outside. And to the extent alcohol goes into restaurants and hotels and clubs, it will remain dual taxation. Electricity is uncertain. Now they have used the word goods and services. Now what is electricity? Is it a good or a service or neither? And so on and so forth. Actually, according to the Supreme Court, it is goods. So the status is uncertain. They have intentionally left it uncertain because today's states are not in a mood to leave electricity duty. So probably leaving it uncertain means that some way, if somebody gets a better majority in a state, they will persuade that also. Center to import excise over and above GST on tobacco products. So there will be a GST, the three models. Now you can see something is completely out, something where both will levy, but center would levy an additional component on tobacco, and electricity is uncertain. There will be a mini parliament, GST council, where each state will represent itself through a minister, most likely the finance minister of a state, headed by the union finance minister, which will take all decisions. What rates to recommend? Now, constitution, you don't want to provide anything. These will always be flexible on what goods to impose, what is to be exempted, and so on and so forth. What is important from your point of view is that before anything attains finality, you must contribute your inputs. Because once they get sealed, it means every time you want to change literally a comma, 1 plus 28 have to sit together. So it's going to be a far more time consuming process to get changes once they are framed. I think this is done. Now what we've done is, or the government has done now, is that a lot of steps they have taken because GST was getting delayed, and the mandate given was that let's get as much closer as possible to the GST so that it doesn't become like an earthquake. Otherwise GST would have been like an earthquake. It's such a huge reform, everybody would have been running helter-skelter. Consultants would have made merry because getting a consultant itself would have been a problem. Okay, please look into my affairs. So a lot of things have been done in the last 2-3 years. Now the exemptions have been harmonized. A lot of exemptions are being quietly withdrawn. Government imposed 1% tax in 2011. They jacked it up to 2%. Actually 2% comes to 6% because 2% is without giving credits. So they have given option that you can pay either 2% or 6% with credits and so on and so forth. Negative list of services was introduced in 2012, which means all services are taxed barring negative list. Central excise service tax provisions have been aligned in a number of areas. Input tax credit rules have been harmonized between goods and services. And these two rules, which are very, very complex, those who deal with services would know. In 2011, these point of taxation rules were, because you are dealing with intangible. When is a service provided? You go to even a simple thing like a haircut. When you enter the shop, when you sit on the chair, when he finishes your haircut, and then you go for something less, something, let's say, pedicure, manicure, when did the whole thing finish? And meanwhile, if technically the rate changes, you can imagine the complexities. Now imagine telecom sector, running bills are going on, and suddenly government tells that this is the change of rate or some other policy measures, how you are going to be billed, people are going to get demands. There are other complex sectors like construction, where projects go on for years, and a lot of changes happen. But today, most of these have been streamlined. Some issues might still be there, and if you have any questions in any sector, we will take them up later on. But one thing which has not really disturbed us so far, but will disturb enormously when the GST actually comes, is the place of provision. Right now, it doesn't matter whether you get assessed in Delhi or Noida or Gurgaon or so on and so forth. All the taxes are central taxes in services, so you pay the same 12.36%. But you imagine in the GST scenario, where a service is deemed to be provided will become very important. And states may not have the uniform rate. So if you take a flight from Bombay, stop in Jaipur, come to Delhi and then go to London. So let's say Bombay, Delhi, London. Is this tax liable to be collected by Maharashtra or Delhi or not at all, because your destination is outside India? And do you pay tax on when you return back? You have your headquarters in Delhi where you have an architect, you do design, planning, etc., but your construction site is in Odisha. So are you liable to pay tax to Delhi government or the Odisha government? Is this transaction an export or an import? And your sector, of course, is going to be impacted if your export definition doesn't really capture what it is. You have a buying agent or a selling agent abroad, and he's giving you services. Are they import or are they export? So all these complexities, place of provision is going to be the most litigating subject in times to come. And states are going to fight now. They won't let another state take away their taxes. So you sell, for example, a prepaid card in Delhi. The customer has a residence in Gurgaon. Now, Delhi will say the card is sold in my state. The telecom will tell him that the customer actually resident in Gurgaon. Will Haryana get tax or Delhi get tax? But all these rules have been made now based on some international provisions, but they need to be tested in a complex situation. Most importantly, the government is now at a very advanced stage of setting up the information technology network. Mr. Nandan Nilekani is leading this initiative. A special purpose vehicle company has been incorporated, launched, is chairman appointed, like private sector. 51% shareholding is with the private sector, 49% with the government, and it is giving the most modern infrastructure. Now, if I tell you all the wherewithal of this, we get a feeling when we were in the government that tax evasion is going to become extremely difficult now. We'll come to that a little later. So government is rolling out a very, very sophisticated network of intelligence in the GST network. Team is working on enacting or drafting the common law or the GST law, which is expected to be uniformly adopted by all the states. So all the various different provisions that you see across states are going to be completely eliminated or more or less eliminated, barring some small little things. If some state wants to have some more columns in the invoice format, they will have the privilege. The basic columns will be same. So the challenge on a macro level, if you see now, is the following. That are we getting a very right kind of a GST? You have practically everything sandwiched between central government and the state governments. It's not that state governments are uniformly taking one stand. There is a stand on petroleum. Let's say Northeast Assam would feel that petroleum should be like this, or those who have petroleum, they feel one way. Punjab, Haryana feel that purchase tax on mandis should last. Maharashtra feels octroi should be continuing there. Gujarat feels the origin is very important to some of the states. And then states in general feel some issues vis-a-vis center and so on and so forth. But if you see from the point of view of the business, what is very important is that we should get a very compact, comprehensive GST. If you still have to pay a number of taxes, then I think the very purpose of having a GST would be defeated. So you have been told that petroleum, electricity, alcohol, and some other taxes are still outside the network. There are some ambiguities. For example, amusement, entertainment sector, local bodies will have the powers to levy taxes. So they can go berserk. Like UP today has an entertainment tax rate of 60%. So it acts. And what is an entertainment? Madhya Pradesh thinks the ringtones are entertainments. When you have jokes on telecom, it's entertainment. So they have started taxing this part of the telecom sector in Madhya Pradesh. So the moment you make an exception, you can be sure there are people on both sides waiting to give it a distorted meaning or whatever they suits them, and therefore make the whole structure complex. Cost of compliance. Naturally, when we talk GST will be a game changer. It should reduce the cost of compliance for the business drastically. Your litigation should come down. Your requirements to meet inspectors of any kind should come down. Because you should simply be clear that, okay, I've invoiced this much, paid X percentage tax. I've taken all credits that have come in. Now, New Zealand has that kind of a tax. New Zealand tax system is rated to be the best that way. And their finance minister was very clear that whether you eat an apple or a vegetable or a McDonald's food, there is no difference. It gives an impression that going to McDonald's in India is a luxury, or at least better than a necessity, and fruits and vegetables should be exempted. He said an apple costs in Indian rupees roughly 300 to 400 rupees an apple. McDonald's food will be 60 bucks or 80 bucks. He said, why should the government be deciding what the people want to eat? So they have taxed everything practically, but except personal residence, renting. Even diplomats are taxed in that country. They don't want to distinguish anything. This question I have faced so many times, Mr. Garg, your law is too complicated. The way to make it simple is everything is taxed at a 10% rate and all credits are allowed. Full stop. After that, you don't need this complex rule, how to allocate credits, proportionate this thing, rule 6.3, this denied, that denied, nothing. Anybody who exports gets a drawback. There's no other scheme. Full stop. That's the kind of law people have been able to have. Europe, which was one of the first to introduce, is today one of the most complex system. So, only system one should think of imitating is New Zealand. But then you have to think, one good thing in this developed country is that they collect taxes from everybody, then they send checks or aid or subsidy directly to the poor's accounts. So they know who their poor are, they know their bank accounts, and they are able to reach the money honestly directly into their accounts. So India is attempting that indirectly through this UID and then financial inclusions and so many things. But you know the question marks that are there on that account. So some of the things that you see generally happening in the economy, they have implications on even your tax design system. So sometimes tax planners are not to be blamed because their efficiency depends on the efficiency of the remaining tools and techniques that they have. One of the most worrying signs which is not yet tested is the consumers. Now you will find that big business is generally in support of GST. All the major chambers are supporting it and so on and so forth. Why? Because the rate for the higher tax will come down, rate for the lower taxes will go up because you're converging, you're going towards a mean rate or an average rate. Goods will become cheaper, services will become expensive. Services today only central government taxes, states will also start taxing. So there are very few chambers of services, most chambers of goods, very few chambers of small scale industry, large. So you can imagine the game, what is there quietly. What is not being taxed today? Food sector, relatively less. Textile sector, which you belong to. And to a certain extent, construction sector, real estate. Put these three words in Hindi, what do they become? That is the acid test of the GST. That is not yet at all tested. And world over studies have been done, and when you give a relief of 1 rupee to the industry, 30 paisa is passed on to the consumers. 70 is retained. But if you withdraw 1 rupee, if you impose additional tax of 1 rupee, then it's not that 30 paisa is passed on. Now this is how do we optimize. Now people are thinking that we will make a law, force industry to pass on the benefits. I don't think it's going to work at all. Persuade, I don't know. And if you find post GST, goods don't become drastically cheaper and services only become expensive, there'll be hue and cry. Now take a country like Canada, very modern, straightforward, honest society. They were giving huge financial aid to their states to join, voluntary. One of their biggest states called British Columbia, second biggest perhaps, joined. And it became hue and cry in the country because restaurants became very expensive. Unlike India where restaurant is a luxury, there it is eating out. And practically every family is eating out. Restaurants in most part of the developed countries has low tax rates relatively. If the normal rate is 15, restaurants will be 7 or 8%. tax. And they call them labor-intensive sectors, so they encourage that more and more people should get an employment. So restaurants are not taxed very high. Became a big issue. The governor said, okay, I'm going for referendum. If you people vote it out, I'll withdraw. Under the law, anything to be voted out required 50% majority of the registered population of voters. He said, even if 50% of the people who vote or go against, I will withdraw. 51% voted against. He lost in 2010 or 11. 11, I suppose. So they are going to withdraw this year, I think, or they've withdrawn already. They were to withdraw this year. They had taken $4 billion aid to introduce it from their federal government. So now people are realizing, how are we going to give that money back? Investment is going to fly out of that state, and so on and so forth. So the slide I showed you in the beginning, how many countries have withdrawn it? At least states you can see, British Columbia. Now it's not 5, it's going to be 6 now. Those who have withdrawn. Whether they reintroduce it, we don't know. But the reason I tell you, their consumer studies came, each citizen on an average was paying $350 higher under the GST system than they were paying previously. In India, we can never be so scientific and so on and so forth. But I think this awareness needs to be created. Okay, how do we do that? And then I have shown you impact on the sectors which are outside, and we are going to take up your sector after this. Now come to the textile sector. I'm not an expert on your sector, but I try to understand some of the issues that could be applicable to you. The first thing, and one has to take one's own judgmental call, is that if we get a reasonably good GST, and I have a feeling that despite some shortcomings, it's likely to be a decent GST unless states mess it up or the rates become too high. Then they say GDP leads to GST leads to a higher GDP. I'm personally not hopeful that GDP will go up to 1.5% or 2%. 1.5%, to put it in perspective, means roughly 150,000 crores of additional income in the country generated. So, but definitely I feel if things work fine, even 0.5 is more or less likely. More GDP means more demand, and more demand definitely means more clothes, and your sector to that extent should feel. But there are a few crosses you can see, so one has to take one's own call. What is the likely impact of the GST on the GDP and then on demand on a respective sector? One formula that you need to know is that higher the taxability of a sector today, higher the gains, and vice versa is also true. If you have no taxes today, then it is negative gain, generally speaking, for a sector. Clothing is likely to become more expensive because now the central excise duty is nil on ready-made garments. And it's unlikely that it will be given a merit rate treatment. There are going to be two rates in GST. Low rate will be 6%, higher rate is being worked out. Some believe it is 12%, some believe for some states it's as high as 16%, etc., etc. Government may introduce it at 10 or 11, and then states may jack it up. So all various permutation combinations are there. But in either situation, it looks that the taxation on the apparel sector is likely to be more than it is today. The distinctions across fabrics may wither away. So there are cotton fabrics in pretty in one manner, acrylic and other nylon and polyester and so on and so forth. By and large, those distinctions and all those things are going to wither away. So cheaper fabrics may become a little more expensive that way. The third thing that is going to happen is the distinction between manufacture and services is totally going to be done away. There is no concept of manufacture. So whatever you do, whatever value you add, it will be supplies. There is a very remote possibility that goods will be taxed at one rate and services at another rate. For the reason they are not sure that goods company will pass on the benefits to the consumers. So there is a line of thinking that let's not give industry the bonus in the first day. We give them only 1%, 2%, and then bring it down slowly after they pass on the benefits to the consumers. And services, let's not introduce straight away with a very high rate of services, 22% or 24%. People may simply not find it acceptable that your telephone bill or your visit to a barber or etc. has become overnight so expensive. So one could be that you introduce services at 16 and then slowly bring them up to, imagine air travel where you have a huge abatement today. You only pay tax on 40% of the value. Railway passengers where you're paying tax only on 30% of the value. Imagine overnight fares going up like, from a 3% to 24%, 21%, and second class going up and so on and so forth. So all those things have to be handled, and which gives cares to people who are implementing that. So in which case, if they start distinguishing between goods and services, then some of the issues will still continue. Cost of input services is going to rise. Right now, my study revealed in general that services are only 10% cost for a business, 10 to 15%. So taxation of 12% on them impacts them 1.2 to 1.5 or 2%. But when both center and states levy taxes, 1.5 will become 3%. And if it is going into an exempt sector, like let's say small scale, he has to bear the cost. If you are not into the chain, it becomes an embedded cost for you. So it will have a significant impact on the sector. Your sector has been exempt, and one really, dreads to think how are you going to handle such a huge sector, so many varieties and problems. This also quite to understand. A lot of hidden taxes will now come upfront. They were getting embedded as costs. So you will gain a lot because your exports refunds will particularly become very transparent. You'll be able to ask for more refunds. Capital goods credits and so many other things will be now just embedded, and straight away you can claim them. And imports will become naturally more expensive because imports have to pay a CVD equal to the excise duty. Now that will have both center and state components and so on and so forth. So right now they were only paying the central excise duty, and that too MRP minus something, abatements and so on and so forth generally. So all that will make imports less competitive, and therefore that is the why people talk GDP will go up, because exports improve and imports come down. Indian industry gains. This is the basic model of a GST, and that gain will come generally to manufacturing in India, and your sector to some extent should get a benefit of that. And small scale exemption is likely to be, I don't know what should I say, raised or brought down, because VAT exemptions are 5 lakhs or 10 lakhs in states. But centralized exemption is 1.5 crore today. Service tax exemption is 10 lakhs. So the average that is being agreed is 25 lakhs, a small scale exemption, and up to 60 lakhs it will be a composition scheme, means you just pay some 1% tax and no records to be maintained and so on and so forth. So one has to see for your sector's point of view, is it good or bad? Because up right now textile is out of the excise network completely. When it was introduced in 2003, these are the kind of exemptions. So one has to evaluate where does one fit in. Impact on cash flows. This is another study I had done, because now input tax credits would be available across states also, but then states have a problem that they want their money immediately. If some input has come from, let's say, Punjab to Delhi, Punjab says, give me my money. Delhi says, give me my money from Punjab. I will not give a credit from Punjab unless you hand me over the money. And how does center give money to Delhi? So it is going to make the vendor pay tax into the account. You cannot get a credit unless your vendor, you have made the payment to the vendor, and vendor has made a payment of his tax to the government. So government is working out on rules that credits will be allowed only and only if the vendor has paid the taxes through the GST network, which means a significant cost. This also means tax evasion will go down. Nobody would be able to get easily fake credits. each invoice verifies automatically, because you have to reach money to whichever state it belongs to, destination based, and money has to be got from the origin. So if somebody is showing any fake invoices, automatically the system will detect that the money has not been paid at origin. So the problem of all these fake credits, at least on theory, unless somebody proves otherwise, looks brilliant in this scenario, and that is going to bring down. There's a huge evasion, and therefore legitimate business is being made to suffer a lot today. That's how the rates will come down. Then simultaneously, government has opened retail sector, and today retail is only 4-5% of the total GDP. It is expected to go up to 20% in few years' time. Basically, organized retail means bill. And if there is a proper bill at the last stage, I'm not making a sacrosanct statement with all the limitations, but generally speaking, organized retail will make the bill, and therefore, if final stage pays taxes, one is not so much concerned. At the previous stages, automatically the tax is captured. So improved tax collections. Improved GST collections means improved income tax also. So one believes that over 3 years' time, 2 to 3 years' times, tax rates are likely to come down, and that will be the true victory for the nation and both sides put together. As taxes come down, the propensity to evade will also go down. If taxes are higher, one feels more motivated or incentivized to evade taxes. And therefore, one believes that evaders will have the most to lose in the GST scenario. Then you have, for your sectors, some specific issues. One has to think out how principal manufacturers, contract manufacturers, and those would have to be tackled, but one has some experience of the past, whether those dispensations would need to be brought into the GST for apparel sector, and then those who are operating in EOUs and special economic zones and special parks and schemes and so on and so forth, or Northeast and Uttarakhand and Himachal Pradesh and so on and so forth. How will they be tackled? Those things one hasn't really applied mind. One view is that treat them normally, but whatever tax they suffer, refund them at a subsequent stage. So I think some amount of thinking is required to be done on this. Now I come to some key service tax issues. 2012 is a watershed year, and I consider myself fortunate to have been at the helm at that time when all these reforms happened. I was given a free hand to do that. So if something is wrong, you can blame me on this. So today, most services are taxed, barring those in the negative list. But your sector has a dual protection. Many times people ask me, such and such officer is harassing and so on and so forth, because they do some small little operation, which officer may say doesn't amount to manufacture. So if it is not a manufacture, then textile sector is still excluded from the levy of service tax by virtue of this exemption. 30A, I suppose, is the serial number of that. So there is nothing to worry in the existing dispensation on the levy of services on textile sector. What you need to worry is the indirect issues that impact you. Many input services have been taxed, which get embedded as your cost. I think your main issues today are reverse charge services. You are liable to tax on import services, on manpower supply, which is a big issue in your sector. Manpower includes security services also. You engage a lot of people on, you may call them contract manufacturing. I'm aware of the issues that sometimes the contractors could be very genuine, sometimes they are not so genuine. They are not paying provident fund and other or complying with the other requirements of the labor laws. So one gets into a very difficult territory that you really never, because the liability to pay tax is now on the recipient of the service. So the contractor is to only pay 25% of the tax, 75% of the liabilities on those who have engaged it. Many are not considering that you have given a job of stitching to the contractor. You are only hired, you have taken a manpower, and it's your manpower and so on and so forth. GTA is another head on which liability could come on the textile industry and directors' fees. What I really shudder to think is there are a lot of unclear issues. Unfortunately, after the negative list was introduced in 2012, one couldn't really do some work. There's always some denting, painting jobs when things move into the field. I think that work hasn't happened, to my understanding, to the desired extent. So there are very unclear issues, like if an employer to employee services, you are giving him a canteen facility, a guest house, or telephone reimbursement, or cab, and so many other things that gives. Globally, there are very varying practices. The understanding today within the ministry when I last left was that they're all liable to be taxed. I'll be very surprised to hear if anybody is really paying tax. So one shouldn't have a situation where the government feels everybody is liable and field situation is nobody pays the tax. So I think those are disturbing issues, and one should take them up hopefully when the next budget exercise is there. Somebody should really identify now for the countrywide as a whole, and any chamber, any association, you would be, if you are aligned to national apex chambers and so on and so forth. One of my disappointments, if one can say, with generally the chambers has been that the quality of involved think tank kind of a thinking has been missing. What they do is they contribute a membership fee, then they hurriedly engage a consultant who does some report and it pushed. That's not how serious reforms are handled globally. It has to be a process of engaged discussions. You are represented on serious policy making forums. One has to persuade first of all the government that no major change should happen unless some people who understand those subjects are involved and their views are taken, and you're there. I've only given you a little bit taste of some of the things. One can go in each of these, and then things start becoming more and more difficult. And then there are issues of export refunds. I would like to believe that things are much better than what they were 3 years back, but still I know that exporters are not getting a full refund because rates are very poor. One of the reasons is that your chambers have to represent ministry and demonstrate that your tax costs are higher. But there is a procedure, and I suppose if procedure is followed, some of these things can improve in the service tax regime. So now I'm towards the end. Basically, what I'm trying to say is that apparel sector will face very significant challenges in the GST. You've enjoyed a fairly tax-free regime, I would say excise duty, particularly for the last many years. So, and the impression that I get that the level of awareness of your problems is grossly inadequate on both sides. Certainly within the government, because they tend to look at GST as a once-fit-all situation. It will fit everybody, whatever GST is designed. But each sector has its own exclusiveness. Your sector in particular, there are all kind of issues in textile sectors. If textile can be handled, I think the entire GST can be handled. It's like, if you can drive in Chandni Chowk, you can drive everywhere. So I think yours is one sector where it should be tested that yes, if it meets all the requirements. Jewelry we had problem in 2000 and I think 12 when we introduced central excise duty. Same problem. Small artisans, big ones. It looks that it's a very valuable item. It should be always taxed, but it doesn't happen exactly in the same manner. So we should identify. I have identified some of the issues for you. But this work needs to be taken up further and a coherent strategy designed for each issue. That is probably the right way to move to this thing. And lastly, some areas of service tax need clarity. I made this slide 2 years back. My vision of our tax in India is, see, right now they are working like compartmentalized taxes. I could demonstrate to you that there are very little distinction between income tax and indirect taxes. Income tax is a tax on your profits, and all VAT value-added taxes are a tax on your profits and wages. So actually, if you see, value-added is theoretically that there should be only one tax in the country, either a direct or an indirect tax. But those arguments are separate. But even if there are two taxes, they need not be collected in two completely different ways. Litigation processes, so many other things one can harmonize. And when country is placed at a situation of introducing two major reforms, DTC and GST, I think there is a need that some of the chapters should be common to both the direct and the indirect tax laws. I think that must be a vision for this country. And if you can reach that, then you won't need to invite me ever again. Thank you.